All right, all right. We are back. I miss you guys. I haven't seen you since last Thursday. Thursday, Friday, Saturday, Sunday, Monday, Tuesday. Thursday, I saw you. Friday, Saturday, Sunday, Monday, Tuesday. It's a long time. Summer schedule. We're on the summer schedule. All right. So we're on the summer schedule. We'll start back up every single day back when we get back at the university. This is our university lab, and so this is the summer labs. This is summer class, summer school. Remember when we went to summer school in high school? We were just kids, and we went to summer school. It was a lot of fun. We liked summer school, right? Because why? Well, it was easier. It seemed a lot easier to me. I don't know. It seemed like all we did is, finger paint and draw stuff, paint things, make things. So we're trying to be trying to have fun in summer school. All right. So think of it as camp. This is like computer stock market camp. All right, summer camp. All right. We have a nice schedule here. We actually have a schedule. And so the schedule is that we are now in week 3. And week 3, we've done a little bit of the poor man's covered call stuff. We're going to review some of that. And then we've done a little scalping on Wednesday. We're going to do a little scalping. That's tomorrow. So come back with us on scalping on tomorrow. And then we're going to do seasonals on Friday again. All right. We touched on those a couple weeks ago. We're going to circle back around on Friday and do seasonals. Seasonals are fun. Now, I don't know. It's funny. The seasonal nature of markets is kind of an interesting thing. We're going to do that on not Friday, sorry, Thursday. And it's fun. I like the seasonals. And I've noticed that when I do the seasonals, fewer people come to class. And I don't know why that is. Because it's interesting. When I did seasonals, when I first started this a couple years ago, it was a year ago to a couple years ago. I don't remember when I started doing the class. Seasonals were really popular, and a lot of people would come to those classes. But lately, when I do the seasonals, I don't get as many people. But I like the seasonals. We have fun doing the seasonals. Seasonals are interesting. So come and join us Thursday. We're going to do seasonals. All right, what are we going to do today? What's on the agenda today? For today, we're going to learn a little bit about recurring price patterns. Now, we have to study those because they're part of the overall longer-term trend in investing model. Now, I also wanted to touch on something today because I had a student write into me, and I don't think he'll mind me giving his name. His name's Tony. Tony, if you're here, it's good to have you. Glad to see you. I'm going to talk a little bit about your comment that you sent in. And Tony's one of our long time students, been with us for a while. And I met Tony in person, so it's a lot of fun to have Tony in the classes. It's always nice when I can meet some of you guys in person. And Tony had a question about what he's hearing out on the internet about the YieldMax funds. And we're going to talk a little bit about those today. We're going to try and cover a little bit of YieldMax. I'm going to pull up, I've got my new spreadsheet is almost done. I'm almost ready to give it to you. And I'm going to show you mine, show you my real money account spreadsheet, and then show you that that's the spreadsheet that I'm going to try and get out to you. We haven't quite got, Ben, my son, hasn't quite got, he and I started a new business together. And we're going to have this portfolio put into an app that you use on your phone, so you don't have to sit here and do all this spreadsheet stuff. If you want it, you still do the spreadsheet if you want to, but we're going to have it all put into an app that does it for you automatically. Just kind of getting the fine-tuned pieces to it. Haven't got it quite fine-tuned yet. And so Tony sent in a note, and what he said is he was like, Lan, I'm hearing a lot of concern about the YieldMax funds. And I'm going to start off with this just to kind of give you an idea of where he's going with this. He's like, they're concerned, people who own the YieldMax funds are concerned about the NAV, the net asset value, and and how it doesn't grow. And I'm like, you know what? I've talked about this a million times. And of course, I gave him a nice long detailed explanation, but I want to kind of highlight it to you guys. The YieldMax funds are not supposed to have big NAV. All right. In fact, they suppress the NAV on purpose. And the reason they do that is so that you can buy the shares at a lower price. All right. Because if you have big NAV and the share price goes way up, then you have to pay more money for your shares. And if you have to pay more money for your shares, well, then you don't make as much money on the dividend payout. Because if you buy the shares and the NAV keeps going really high, what's the point of that? The point is not to have a big NAV on these YieldMax funds. And I'm going to take you over and show you just real quick. If we go into Tesla and look, this is Tesla, TSLA, right? Tesla. All right. So there's Tesla, and it's kind of rallied pretty big. And that's gone from $250 down here, $229, all the way up to $350. That's a big move. So let's come over and look at Tesla, TSLY, which is the dividend version of this market. So here it is. It's gone from $7 to $9, $2 up. It's actually a big move. That's a big move. Now, you see this big drop here. That was a big drop from $16 at the peak, $17 to the peak, all the way down to $7. So that was a big drop. That was $10 drop. Of course, the whole market flushed like a toilet. I mean, you can't not. I mean, if the market flushes like a toilet like that, you can't not lose money. It's like, oh, I lost money in the Tesla funds. Well, the whole market lost money. I mean, the whole market went down. The thing about the Tesla funds, when I did it, I just kept playing parity. Every time they'd give me a dividend, I'd put it back in, and I'd put it back in, I'd put it back in, I'd put it back in. I didn't take any and go spend it. I just kept putting it back in. And so now when I'm at the bottom, I didn't lose any money. Very, very little. I mean, I couldn't quite keep up with parity on some of them. Most of them I did. Most of them, every time they give me a dividend, I'd put it back in, and that would cover the loss or the downslide. So I managed through this big drop beautifully with I got $1 million in these funds, and I didn't lose hardly anything at the bottom. I was like, oh, I didn't lose anything because I kept playing parity. I kept dropping it in. And then when I get to the bottom and the market starts to rally, it hasn't hardly rallied at all. And I'm already back to, I'm making money. I think I've made I was counting yesterday, I made like $200,000 so far since the rally started, because I went parity all the way down, reinvesting it all, buying my shares, dollar cost averaging all the way down. And now I'm back to making a big chunk of money again, clear back to full profit and way above. And so it just depends on how you play these markets. These markets are not passive. Tesla, I mean, these YieldMax funds, there's something I have to kind of say. These funds these are fire, man. You're playing with fire when you're playing with these funds. They come with a lot of leverage, and they come with a lot of whenever a lot of possibility to make a lot of money. Whenever you have that leverage, you have the chance to get burned. I mean, there's no free lunch in the stock market. So you got to be careful whenever you can make this kind of money, and you're like, this is unreal. How can they be giving me, look at this, 76 cents for every share I own, and the shares are only $9. That's a lot of money. That's a lot of money every month. There's 86 cents, 66 cents for every share that I own, and the shares right now are only $9. You can buy them for $9. You're playing with fire when you play with this market. All right. And people are like, oh, my NAV is going down. Oh, I'm worried about my NAV. Well, all the NAV is the growth of the stock. It's like if you put money into YieldMax funds, you don't want them to grow. That's the point of being in the YieldMax funds, people. You don't want the NAV to grow because you want to be able to buy more stock, more of their shares, because you get your dividends paid on the number of shares you own, not on the dollar amount you paid for them. You don't want the NAV to go up on these funds. So please don't get confused between what the strategies are. Two different strategies. Like, oh, I don't like these funds because the NAV decays or the NAV never goes up. I want big NAV. Well, if you want big NAV, there's another symbol for Tesla that you can use to get big NAV. It's called TSLA. If you want big NAV, go here. Put your money in there. That's what I do. If I want big NAV, I'll put some money in here and I'll put some money in TSLY. TSLY gives me big payments. The NAV is suppressed. It's suppressed for a purpose. It's suppressed on purpose so that you don't have to pay a lot of money for the shares. If the NAV starts to go up, they give bigger dividends. Have you noticed that? Look, let's go back to TSLY once again. TSLY, and look at the NAV down here. The NAV's going down, they give you 66 cents. The NAV goes up, they give you 76 cents. That's 10 cents in a month more that they increase their dividends. Well, what's that going to do to the NAV? It's going to depress it. It's going to pull it back down. Why would they do that? What, don't they want it to grow? No, they don't want it to grow. People, they don't want it to grow. Why? Because then you have to pay more money for your shares. If you have to pay more money for your shares, then the 66 cents doesn't mean anything because it's a percent increase. Does that make sense? I hope it makes sense to people. You don't want big NAV in YieldMax funds. Does that mean you're supposed to put all your money into YieldMax funds? No, of course not. I mean, I say I have $1 million in there, but it's growing to $1 million from about, $500,000. And so I don't know how to get it across. I've tried. You don't want this fund to grow. You don't want it to. And there are people out on the internet who don't understand the concept. And I've tried to explain this too. I've tried to explain to you. You're going to go out and you're going to see people on the internet. Everybody hates these funds. They're stupid people. Don't listen to them. They don't know what they're talking about. People who you would think would know this stuff, who would be really smart and understand. And it'd be like, that guy has 1 million people in his following and he talks about stock. And why does he say that he doesn't like the funds? Because he's dumb. I don't care how many followers he has. He's dumb if he's telling you about it and saying, oh, these YieldMax are no good. They're not good. That's the point. They're not good. Okay? They're not good. You don't want them if you're looking for growth. They do not grow. The point is they don't grow. They're not supposed to grow. Okay? They're not supposed to grow. If you want growth, mix. Go a little bit of Tesla. Go a little bit of Tesla. Tesla for the dividends. Tesla for the growth. But don't ask TSLY to grow. It's not a grow fund. You don't want it to grow. That's the whole point. All right. I get a little excited about this stuff, and I'm not angry. I'm frustrated because I want you guys to understand how it works. All right. And there's a lot of people who hate these funds. A lot of bad, and I get it all the time. Tony's not the only one that's writing in and saying, hey, you know what? They're trying to make the NAV grow. I don't want the NAV to grow. If they change it and start growing the NAV, I'll put my money somewhere else. I'll pull it all out. That's not the point of these funds. The point of these funds is not to grow. If I wanted growth, if I wanted big NAV, I can control the NAV. See, that's the whole point. You can run a balance. You can run a balance. You want zero growth, zero NAV, put all your money in TSLY, none in TSLA. Oh, I want a little growth. Okay, pull some out of TSLA and put it into TSLY and put it into TSLA. You can control how much you want growth. You have that control. You want more growth? Put more over here. You want less growth? Put more over here. Let's do it strategically. If the market starts to rally big and you get way up and the TSLY starts going really, here's a perfect example. Let's go talk to PLTY. All right, let's go PLTR first. Look at this baby. It's up way up there. We're going to talk about this a little bit, but look at how high it is. It broke previous highs right here. It broke previous highs. Look at how high that baby is. It's way up there, way up there. I had a lot of money in this market. I had a lot of growth. Okay. PLTR. I rode that NAV, big NAV, grew big, but look at PLTY. PLTY actually had too much growth. Look at this. Not nearly what PLTR did. Look, PLTR went all the way up and broke this previous high. PLTY did not, right? PLTY, well, it did come and break this high here. and it's had too much growth. It's gone from the low down here at $45, $48 all the way up to 70. Geez, it almost doubled. That's not good. People, that's not good. Now, they gave big dividends. Look at the dividends in here. They were doing $5 here per share, and here they're doing $4. They lowered it. But you watch, the next time that this thing pays a dividend, when it comes up, it's going to be a big dividend. It'll probably be back up around $5 again. I'll bet they break 532 right in here. Why? Because they're trying to suppress the NAV. They're trying to get that baby to fall. They don't want it to rally. If you want rally, if you want big NAV, do a mixture. Some in PLTY, some in PLTR. When PLTY gets really high and looks like it's going to come down, roll your money out or roll it into PLTY. That's what I do. When it drops back down, I roll it into PLTY, roll it into PLTR, back and forth. Use strategy. This is not your father's buy it, set it, and forget it. PLT, YieldMax funds, you're playing with fire, man. This is high risk, high leverage trading. All right. So you are on bleeding edge of technology trading. These things are only 2 years old. We don't even have any history on them. We don't know how they're supposed to work. We know how they're supposed to work, and they seem to be working pretty well, but they have to I don't like to jump right into the brand new ones. CVNA. And you'll notice CVN, is it Carvana? CVNA, CVNA and CVNY. This is Carvana, all right? When they first come out, they have a tendency to flush. Now this one, see how far back, see that? When they first come out, when they're brand new, look at that flush. This has been out a couple. Oh, this is Carvana. Where's Carvana? That's not the one I wanted. I'm sitting here looking for the beginning flush. Where's it? I don't know how to get back to the beginning on these things. CV. We need to go over to track and trade. I can't do it over here. This little program's not good enough. Come on. All right, we're going to come over here to CV. I just didn't want to screw up our portfolio over here. CVNA. All right, so this is CVNA. So you can see that this market is one of their brand new ones. They just started trading it. So if we go into CV, look how high this thing's going. It's way up there. That's big NAV. Big NAV. Look, it went from $175 to $300 in that last run. If you wanted big NAV, there's your big NAV. But don't ask something that's not supposed to have big NAV, CVNY, to have big NAV. Now, it's been suppressed. See, it's still high. Well, way higher than I want it. It was down here at $25. It's now up here to $45. Right? That sucks. It went up there and broke this high right up in here. See that? So you got to play the two against each other. If you want big NAV, go get big NAV. It's at CVNA. That's where your NAV's at. They're going to suppress this NAV. They're going to try and hold it down. And I don't like to get into them when they're brand new, because you see, if you go back and look in the YieldMax funds, they flush almost every single time right out of the gate. And I'm not sure why they do that. I think it's because they're trying to find their footing. They're trying to figure out where they're at, right? I think they're trying to figure out where that sweet spot is. And because they kind of settle down after a little while, and then they start to be okay. And what we want is we want them just to go sideways. Sideways for years would be perfect. And that's the goal of YieldMax too. From what I understand, and what I've seen and what I've read and the videos I've watched, they don't want big NAV. They want them to just go sideways. And the reason they do that is so they try to suppress them so that they don't have big, expensive share price, because they want you to be able to buy the shares at a low price so that you don't have to pay a lot to get your shares, and because they pay their dividends based on shares. So if it starts to grow and it starts to go crazy, they start paying big dividends, which we like, right? But that pulls the NAV down, pulls the price down, all right? Suppresses the price. They do it on purpose. All right, that's the way they work. I think I've driven that nail home. Okay. So back to... Let's see. Rick's asking a question. He says, are there any circumstances where you would get out of Misty or Tesla? You can move money back and forth. And That's a good question, and I don't quite know how to answer it because you would want to. I mean, you want to trade these funds. I mean, let's go use PLTY for an example. The thing about PLTY and Tesla is it the same. Look at the trend of this thing, and I try not to trade the trend of PLTY. If I'm going to come and decide whether I want to get into or out of a market on PLTY, I don't do it on PLTY. I do it on PLTR. And same with Tesla. I don't do my technical analysis on the YieldMax funds. I'm not looking at the YieldMax funds to do my technical analysis. I only do technical analysis, read the mathematical models on the underlying stock, because it's the underlying stock movement that increases or decreases the NAV of the yield, or the NAV of the YieldMax fund, right? So if we do our trend lines along here, what do we see here? I mean, this market has been on fire again, just like it was on fire here. Well, I don't think this market will ever fall. Well, it has to. It can't not. It has to. Not the, I mean, how far is the question, but it's going to have to break. I thought it was going to break here. Let's draw our trend lines and let's do our little mountains, right? We do our mountains. This is part of what we wanted to do in this class. We're going to talk about recurring price patterns, but this is not very well formed mountains, but here they are. You can see them in here. There's the first one, right? There's your first little mountain drive. Here's your second little mountain drive. And here's your third little mountain drive. We try to count these, right, as they're happening. And then we're like, well, I think this is a X2S A1, right? That's what we said, is X2S A1. We measured that, we counted it, and we said that's X2S A1. Well, that first little mountain, we got a little kind of this little thing here, and that happens a lot. You get your first little pennant formation, and that's what these are. These are little pennant formations. We call them pennant formations in the market, right? And that's what some of your most important little recurring price patterns are, is these little pennant formations. All right. So a pennant formation is part of the Elliott wave, or the longer term drive system, all right, that we look at. So everything's based on, we have all this technical analysis that we do, recurring price patterns, longer term patterns, shorter term patterns, little tiny patterns. All right. So it's all a model that you're building. So you want to count and measure. You want to know where these, and what we're counting and measuring was we're trying to count and measure. We're trying to reverse engineer the mathematical models of the big quant systems, right? That's what we're doing. We're trying to reverse engineer what they're doing, what their mathematical models are saying. And we've discovered that their models kind of stick to the Elliott wave, Fibonacci, recurring pattern stuff. So they're doing these things that make the markets do these recurring patterns. So this is what we're trying to do, is reverse engineer these big quant systems. So that's what this tool does here. So I've tuned in this. This is the big daddy of this blue light is the parabolic SAR, but the parabolic SAR works perfect for this. You can also use the ATR, but the ATR, we use that a lot, but it's not quite, you know, the ATR doesn't quite work as well as the blue light for tracking these, for tracking tracking Aladdin is what we're trying to do. Aladdin is the big king daddy of them all. And so Aladdin is the quant system by BlackRock. And so that's what we're really trying to reverse engineer here. All right. And the ATR, although I love it, doesn't work as well as this blue light to track that. All right. This has kind of been tuned in. This little blue light system's been tuned in with the Fibonacci sequence, which is what's the red, yellow, and green. Red, yellow, and green on the bulls and bears in the track and trade system is the Fibonacci sequence. And then this is the Elliott wave sequence against, and it's been tuned to the best I possibly can to tune it to what I've discovered as Aladdin's quant system. All right. So that's why I use the bulls and bears up here. Now, sometimes we'll turn it off, but this is the Fibonacci. This is why you get in here. If I draw a tool in here like this, you get green, yellow, and red. All right. Yellow is the natural sweet spot in the Fibonacci delta Kona probability, which I have right here for you. the delta cone probability. Calculating the delta cone probability, approximately 68.2% of the time, markets stay within the standard deviation, one standard deviation of the mean. 95.4% of the time, they stay within two standard deviations, and 99.7% of the time, they stay within three standard deviations, which is why we talk about three drive patterns, right? Two drive patterns, one drive pattern. Okay, drive A is the one standard deviation. Drive B is the two standard deviations. Drive 3, that's the three standard deviations. So if we're going to go with these three standard deviations, we're going to look for the market to retrace half or 50% back into the one standard deviation of the overall longer term three drive pattern. That's why we have three standard deviations, right? And we've talked about this ad nauseum, but we've got new guys that come in all the time. So we have to talk about this and help understand the concept that we're talking about here. All right, gonna do that, do this. Okay, so this is the three standard deviations or the three drive pattern. All right, and it happens, it's called fractal. We call it fractal because it happens on a smaller term basis and it happens on a longer term basis. So you have a long-term three drive pattern, but inside of that long-term three drive pattern, you have three drives, but inside of each one of those individual drives, you have three littler drives. And that's what we're looking at right here. So this is one drive. This is going to be our A drive, all right? And you can see that by the blue light. It tells you you're still in the first A drive land. You're in the first A drive. Why is this not the first? Well, because it's already reset. I call this a reset where it comes back and it already does it. So it already did it back here. So if we come back and we look, we can see we had a nice little three drive pattern back here. You have drive 1, you have drive 2, you have this nice big drive 3. And so that's your three drive pattern. This almost looks like this could just be the second drive, and then we'd go back one more, and then that would be your three drive pattern from back here. But it's kind of pressing it. You have to just kind of, hindsight's 20/20, and you can tell. But we're looking for these three drive patterns. So you get drive 1, drive 2, drive 3, and then this is a full reset. And where did it come to? Well, if you take your Fibonacci ruler and you drop that in there, it pulled back into the delta cone of probability, the one standard deviation, all right, which is right here. And so that was very well predicted, right? We all predicted that. We were there, we were here, we were watching it, we saw it happen. And then we got this little bounce here. We labeled that thing right there. We knew that that was an X1 SA1 right here. And we said, hey, we're not going to, what did I just do? Doggone it. So we said this was an X1 SA1 right here, and we're not going to get into the market because X1 SA1 has a very low probability. And that's why we count these, right? We count them X1 SA1. So very low probability of success. And so we're not going to get into that market. But X2 SA1 has a high probability. It's a little bit over 50%. It's like 60% chance that that's going to be your rally point. All right. So this happened on X2 SA1. It took off, and it's now made one drive. So this is our new drive, A drive, and it's got three little drives inside of it. So drive A1, A2, A3. That's how we count that. Now we could come through and put our little tags in here, but in the interest of time, I'm not going to do them all. So this would just be, no more X's here. This is just A2, and we'll do one more. A3. All right. So that's how that works. So this is A2 right here, and this is A3. Now we don't want to be getting into the market brand new fresh at the top of an A3. And the reason is because A3 has a low probability of success. And you can see that it's starting to rally up in here, and that blue light is starting to intercept that Palantir. So I thought maybe this was, I thought that when I first looked at it, hindsight's 20/20, I looked at this right here and I was a little bit like, well, I don't know. I don't know if this is A1 and that's just suddenly an A2 right there. I was like, well, maybe that's our A2. And this is A3 right here, right? Or A3 down here. I was saying maybe that's A3. And that went all the way up and hit that previous high. And I thought we might get a break here. And I was waiting for it to break the blue light. And I said, it's got to break the blue light. And if you remember, for those of you who are here, I was like, it didn't break the blue light. That's kind of pissing me off. It needs to break the blue light, or else it can't be a new drive. It can't be the end of drive 1, A drive. So if you look at this happens a lot where it comes up, breaks the blue lights and makes a little pullback and then continues. And you just have to realize that that's not going to be, you got to look for your little mountain here. All right. So this comes in here. This is your A2. And in hindsight, it's obvious, right? It's obvious. You're like, oh, well, obvious, Land. It's a 3-drive pattern. Drive 1, drive 2, drive 3. There's your 3 little mountains. Well, as it's building, it's not so obvious. So it's a little bit harder to do things on the fly. You just have to realize that's the nature of the beast, right? That's the game we're playing. Who can read these charts better than the next guy? All right. So now we're coming in here, and it's got to break these blue lights. And I kept saying it's got to break the blue lights. You can't call it a retracement until it breaks the blue lights. And so here they come. Now we got to have the blue light set to 72. That's key as well. This has to be set at 72 for this model. Now you can adjust that when you're doing other models. All right, you can make it be more or less aggressive. You can do whatever you want. But I've tuned this in, and that's the defaults. And I like to use the progressive formula right there. So then you got to turn on the blue lights right there. And then this is tuned in at those settings. This is tuned into BlackRock's Aladdin algorithm. All right. Now, is it perfect? No, it's not perfect. Nothing's perfect, but it's the closest damn thing I've ever seen. All right. And I've worked on it for years to build this thing. And most of this formula was given to me. I didn't make it up. All right. Somebody from the Chicago Board of Trade gave me this formula. Okay. So this is how this all comes out. Now we've got to look for this to break those blue lights. And when it does, where do we think it's going to go? Well, the first number, it's got to break the blue lights, and it looks like it's about ready to do that, right? We're at the top of the 3rd drive. Does that mean it can't get another little pop and come up here and make a drive 4 and another little mountain? No, it certainly can. And I've seen it do it. And this is a strong market. And if any market could do it, it would be PLTR. I mean, this market's on fire, as you learned. And there's an article in Pit News Magazine where we talk about this and highlight this. This definitely could be an A4 over here. All right, definitely could be an A4. So coming back to the question that I had, is there ever a time that you might sell some of these funds? Well, if you wanted to play the float or play the NAV in PLTR or in PLTY, and you had a lot of PLTY, right now would be a good time to liquidate your PLTY. All right, if you didn't want to hang on to it and hold on to it for the long haul and anticipate it going into the 2nd drive and possibly the 3rd drive, right? And that's what we're looking for on PLTR. We're looking for this market. The fundamentals on this thing are just astounding. We talked about this last week where Kramer, MSNBC Kramer, he was saying this is a meme stock, and I was explaining, no, this is not a meme stock. A meme stock is something that's explosive that doesn't deserve it. All right, these kids get in there and they drive these stocks up that don't deserve to be driven up. That's why they flush back down like a toilet. Palantir is not a meme stock. Now it's very meme. Is it meme? Is that a word? It's very meme because a lot of the kids have latched onto it, but not just the kids. Everybody's latched onto this thing. This is a very popular stock. Why? Because it's growing like mad. It deserves these high ranks. All right. It deserves where it's at. It got put into the S&P 500. Trust me. This is the only meme stock that's ever been put into the S&P 500. That's why it's not a meme stock. I disagree with Kramer. This is not a meme stock, Kramer. A meme stock is a stock that doesn't deserve its high price. And that's why it gets flushed like a toilet. Every single one of them, every single meme stock has flushed back down to almost zero. That's a meme stock. That's what those are. This is not a meme stock. This is just a damn good stock. All right. So this is where we're at right now. And I think we're going to get a break right here. I think this will happen. And if it does, we're going to come in with the Fibonacci ruler. We'll put that in there and it's going to come back down. And this is my hope. I actually hope it does. I hope it falls all the way back down to at least 38.2. And that's really common for these strong stocks. Come back to 38.2 and bounce and start to go back up from there. Now, it would be, I don't think it's going to happen. It might, because it's in the mathematics. I mean, this is all quant driven, right? But sometimes stocks are too strong and the retail crowd and everybody feels left out. They want to get in there too. They don't want to feel left out. They want to miss out. So it might not come back down to 50, or even I don't think there's any way we'll see it back down to 61.8. But that's the delta Kona probability right in here. All right. So what we're going to do is you can liquidate if you want to. All right. You could take your money off, not a PLTR, but a PLTY. Why? Because it's so high. And if it breaks, this is where it's going to probably break and come back down. And then you could, rather than parity, play the parity game, which is taking your dividends and putting them right back in to pay for the loss, right? You take the dividends, put them back in, pay for the loss, take your dividends, put them back in, pay for the loss, and you have to keep putting your dividends back into the fund until you get back to parity. What do you mean parity? There's an article in Pitt News Magazine where we talk about parity. If you put $100,000 into PLTY and the market falls, well, there's two choices you have. All right. There's two choices you have. One is you could liquidate the position before it falls. Well, how do I know when that's going to happen? Well, I just taught you. That's how you know. Is it assured? No, there's nothing assured in these markets. It's all a carnival game, and you're going to pick your carnival booth and you're going to play the game. So if you pick the Palantir carnival booth along the fairway, well, you're playing the carnival. Okay. So it's a carnival game, and you're going to try and have strategy to see if you can't beat the carnival. So if this thing looks like it's going to fall, you're going to take your position at what looks like the highest point, like right today. Let's go take our money out of Palantir. All right, because we anticipate it's going to fall right here after that little 3-drive pattern that we just discovered right over here. Again, does it mean it can't go up to the 4th drive? No, certainly can. Eventually, it's got to break those blue lights. Has to. It can't continue to go straight up forever. The market has to digest the trade, and people have to take profits. And the big quant systems, that's how they do it. They take money. All right, they take money off the system. It's the accumulation distribution model. Trust me, it's going to break those blue lights. The only question we have is how far back down is it going to go? We don't know. We don't know how far back down it's going to go. It'll probably come back down to 38.2. That's my bet on this one. It'll come to 38.2, and then it'll bounce and rocket back higher. Could it go higher? Yeah, it probably could. It could come lower. It could 50, 61. That's the delta Kona probability. That's what we're talking about right here. All right. That's what this is. We've gone up the 3 standard deviations, the 3-drive pattern. We've gone standard deviation 1. We've gone standard deviation 2. We've gone standard deviation 3. Now we're looking for it to retrace. 68.2% of the time, it comes back down into standard deviation 1. And so if that's the case, we're just playing the odds. That's all we're doing. We're playing the odds. All right. So the odds say this thing's coming back down into this region here. So you got your choice, Rock. You can either sell out or you can play parity. Sell out means you sell your positions down there and you buy them lower. Wait for it to come down. And what we would do is at 38, we'd sell them all here. And at 38.2, we'd buy maybe 20%, and then we buy 20% more, and we buy 20% more. So you go 20, 40, 60. So by the time it hits 61.8, you're 60% back into the market again. So your dollar cost averaging down. You're doing what we call accumulation, right? So you're distributing. You're out of money up here. You're out of shares up here. You're out. And on the way back down. Now, what I did in PLTR, what I did is I got in here with like $100,000. And then as it came up and broke up into this region here, I started taking it off. I took off 10%, then I took off 20%. And then when it broke right in here, I took off another like 30%. So I've only got like, from my original 100,000 that I put in, I probably only got about 25,000 left. So I'm only into this market with 25,000, but that's on PLTR, not on PLTY. And PLTY, I didn't liquidate anything. I kept it all. So in PLTR, and I have another 100,000 in PLTY. I have 100,000 here. I don't anymore. I took it off, took my profit as market went, right? Buy low, sell high. So as it went up, I take off 10% here, 10% here, 10% here, 10% here. There's going to be an article in Pitt News Magazine where I outline that whole thing. Now, it's not in this upcoming issue because I got other things I wrote about. But in the issue after that, it'll be the July issue. I think I've got scheduled to do that, to teach this scaling in and scaling out. But it's basic, simple stuff, right? I mean, it's buy low, sell high, and scale out. And then when you get high and it starts to come back down, you scale back in. That's all it is. It's a simple process. So as it starts to come down, I'll start scaling back in. I got a whole bunch of cash sitting on the sidelines just waiting to get back into Palantir. And I said, it's got to break those blue lights. And it didn't break, so I didn't put any in. Sitting here with my little tiny bit. Now, if it breaks right here, I could take out that last 20%. And I might. I haven't decided whether I want to take it out yet or not. Probably will. I just got a last little about 25 grand sitting there in Palantir right now that's ridden up this last third drive pattern. So it's probably time to take that out. And then as the market flushes, I can put it back in, start putting in all this money that I got sitting on the sidelines, okay, waiting for this market to pull back. And I'll scale it back in, buy low. As it comes down, I'll put some in, I'll dollar cost average, pulling that down. But over here in Palantir, could we do the same thing? Yes, we can. But it's a different strategy. We could take our shares off, which is what you're asking there, Rock, where you're saying, where would I sell it? Well, you could do the same thing over here. But because they pay us these big dividends, they're suppressing the NAV on purpose already. So rather than selling out your shares, because the market shouldn't really fall very far in PLTY. So they say they don't, because it's considered manipulation, market manipulation, but guaranteed they do. All right. They can control the NAV of PLTR and PLTY to some degree. Now they can't go crazy, but they can, to some degree, they can control it. All right. If the market doesn't go too much over here in PLTY, they can control it by giving bigger dividends, which will pull the NAV down. And when the NAV's down, they give smaller dividends, which pulls the NAV up. So they can they can leverage that NAV and put it, basically they can put it right where they want it. So if we come over, I wish Track and Trade had dividends. I wouldn't have to keep coming back over this shitty little program here. So CB, so we're going to go into PLTY. So look at this. I'm going to show you. This is how they suppress the NAV. The market goes up $2.98, and then up here, $5.93. Look at the payout between those two right there. $2.98 is the dividends they paid here. And then the very next month, they paid $5.93. Now, why would they do that? To suppress the NAV. Because remember, when you're trading in a YieldMax fund, a YieldMax fund isn't invested in the actual underlying stock. They don't actually buy shares. YieldMax is trading options on those funds. All right. So the money that's in this bucket is not ever invested in the underlying stock. So you're like, well, the stock went up. Shouldn't the NAV go up here? Well, no. The whole point is not to have your money in Palantir. It's to trade options on Palantir. And so this is just your cash reserve to pay options on Palantir. So if they give a big dividend, $5.93 per share, versus what they had here, which was $2.93, what's going to happen to the NAV? Well, this is the bucket of money, and they made a whole bunch of money, so the NAV went up. Well, then what do? They don't want the NAV to go up in PLTY. They want it to stay neutral. So they pay a big dividend, which pulls the NAV down. But they gave you the money, and then the NAV fell. That's why the NAV falls, because they give it to you. They take the money out of the bucket and they give it to you. So if they give it to you as a big dividend, it can't be in the NAV. The NAV's got to flush. Does that make sense to people? Come on, people. Come on. Everybody out there on YouTube, come and listen to me tell you how this works. Quit complaining about this fund. You don't understand it. If they pay you this big $5.93 dividend, the NAV's going to fall. Quit trying to keep the NAV up on these damn YieldMax funds. You don't want that. If you want NAV, go put your money in PLTR. Okay. I'm a little passionate about this. I've done tremendous amount of study. All right. And I understand these things. And I hope I try to help people understand. If I don't know, I don't think YieldMax is going to listen to the naysayers, and I don't think they're going to change the way they do it. Tony made a comment. He's like, there's another company out there called Roundhill. Roundhill has better NAV. Their NAV grows, and I'm like, yes, but their dividends are smaller. It's a trade-off. You can either have big NAV or you can have big dividends. Which would you prefer? You can't have both. There's no free lunch. There's only so much cake you can have. You can either eat your cake or you can leave your cake in the pot. But you can't do both. You can't take your cake out and have your cake in the pot too. Okay? It's like, well, I want to have the big dividends. That's why I'm in YieldMax, but I want the NAV to go up. Well, you can't have both. You can't have the NAV go up and take big dividends, because every time you take your big dividends, the NAV goes down. That's the point. All right. So anyway, let's move along. Okay, so that's what's going to happen here. $4.65 for a Palantir, and when it comes here, I can guarantee you it's going to be bigger than $4.65. I don't know. I don't know what it's going to be. They haven't declared it yet, but my bet is that they've made a big ton of money on this little rally here, and they don't want the NAV to continue to rally, so they're going to give a big dividend to try and pull that NAV back down. All right, so that's what's going to happen. You're going to get a big dividend. Now it comes back around. What do I do with it? Well, Rock, you could liquidate your shares, or when it starts to flush, you just take the shares that they give you, the big dividend, and you just put it back in. All right. So you got your choice. Either way, you're going to have a taxable event if this is not in a tax market. The advantage of doing it with the dividends instead of doing it with the shares is the tax advantage. And so that's the thing that you have to weigh, because if you take the shares off, then you're going to pay a tax. You're going to, considering that it's not in something like a Roth IRA or an IRA, you're out in a normal account where you make money and spend it. All right. The taxes are important here. So if you take the shares off, you're going to pay taxes on it depending on when you bought them. And I'm going to assume it was within the last year. So you're going to pay short-term capital gains on it, which is high. That's a lot more money, right? Versus long-term capital gains. So long-term capital gains, you're going to pay taxes either way, because you're going to get your money back. You're going to sell your shares and pay short-term capital gains, which is more money, or you're going to keep your shares and lose the value in the NAV, but you're going to take the big dividend that they give you and you're going to pay long-term capital gains on it. But instead of taking it and going and buying candy or a motorcycle or food or a house payment, you're going to turn around and you're going to put it right back into the market. And if you do that, you're going to pay short-term capital gains at the end of the year on your dividends. But you're going to put them back into the market. Okay, you're not going to go buy candy. So if you don't go buy candy, you still have to pay your short-term dividends, but you're putting it back into the market to supplement that, and that's what I call parity. That way, if you put it back in and the market drops, it covers that difference. And so if you put your 100,000 in and it goes up and you've been taking dividends, you're making money, and then the NAV's going up, you're making money, and then it drops, you just take those dividends and put them back in, brings you back, maintain your 100,000. And as long as you're above 100,000 that you put in your initial investment, and anything they give you over 100,000, you can take out and go buy candy with it. All right, go buy things with it. Make sure you save some of it aside to pay taxes on. You have to always pay your taxes. Hopefully that ends here soon, right? Trump said he's going to try and get it so that anybody under $200,000 doesn't have to pay taxes. So cross fingers. Don't know how that's all going to work. We'll see. But nonetheless, short-term capital gains is what you're going to pay rather than long-term capital gains. So if you sell your Palantir, you're going to pay long-term capital gains. Unless you've held it for a year, then it's short-term capital gains too. So that was a long answer to a short question. Short question. When would I sell them? When would I not? That's why. That's when. All right. So hopefully that is helpful. All right. Let's come back over here and take a look. I think I said everything I wanted to say about that. So we got our drives, we got our retracements. Now this is Palantir. This is not this is the underlying. This is not the dividend fund. So we can sell this one. We're going to take our profits, because like I always say, if you don't want to pay taxes on your shares, don't sell them. And then you just lose all your profits, and then you don't have to pay taxes. It's a good way to get out of paying taxes. Oh, I had $100,000, but I didn't want to pay taxes, so I didn't sell it and take my profits. So I lost it all the way back down to nothing. Now I don't have to pay taxes. Okay, well, if that's how you want to avoid taxes, then bully for you. But no, I don't mind. I'll sell my shares up there, take the profits. And you're like, but Lan, what if you hold on to it and just go all the way back down and ride it back up again? Okay, well, do that then. That's your strategy. It's not mine. I like to buy low, sell high, take my profits. I'll pay some taxes on it. And then when it goes back up, I'll buy some more, buy some more. It's just a different strategy. If you want to hang on to it over in the PLTY, I'll do that. I'm going to play the longer term. I'm going to hang on to it because I got parity and I can play parity with the dividends. Over here, I got no dividends. It's all NAV. It's all growth. So I'm going to sell out, buy back low later, sell out, buy back low later, scale in, scale out, scale in, scale out, scale in, scale out. Actually, it's the other way around. Scale in, scale out, scale in, scale out. And at the end of the year, yeah, I'm going to have to pay taxes because I made a bunch of money. And usually I take that profit, go put it over into PLTY. So I trade Palantir, take that profit, go. Actually, I've been putting back. If I make money, what I've been doing is I've been putting my PLTR profits over into Tesla because Tesla was still suppressed. It hadn't taken off like a rocket ship yet. So you move it around. You be wise about your trades. All right. Don't be myopic. Move things around. Think about when the next dividend's coming too, because if you wait a month for every dividend, well, you're going to get compounded every month. But if you got dividends that pay in the A group, the B group, the C group, and the D group, right, which is the first month, the first week, the second week, the third week, and the fourth week, and you get paid a big chunk of money in the first week, well, you don't have to wait an entire month to get your dividends to compound. You can just take that one and put it into one that pays in a week. And then you get compounded again. And then you put it in the next week, it compounds again. Next week, it compounds again. And you can compound these big payments every single month 4 times a month, because you go from week to week to week. That's really cool. All right. So 4 times the compounding amount. That's why they do pay some on weekly basis, because they want you to compound 4 times a week. Because if you just keep taking and putting it back in, well, you're compounding. Now, I don't like to put it back into the same stock, because the same stock might not necessarily be the one I wanted in. I might want to have it come out of this one and put it into a different one. So I never have my dividends on drip. Never. Because if you drip it and just automatically have it go back into the same one, now there's some cases where I'll do that, or there's some case where I'll have some people do that. But mostly, I don't do that. I like to have it come out, go into cash, and then I can decide where I want to put all my little chicken eggs, all right, and have them grow the very best I can. So I'm in complete control all the time, but it's up to you. You know, if you want to have just an automatic system, drip it right back into the same one, you can do that. I like to be a little bit more strategic, and I like the money to come out, and I like to put it in places, and I like to put it not always back into PLTY or back into a YieldMax fund. I like to take it and put it over into some stocks. I own some Tesla. I own some Palantir. I own some S&P 500. I own lots of stocks. It's not all in Palantir. All in YieldMax. I take money out of YieldMax when they give me a dividend, and I go buy other things. It's fun. It's a game. It's carnival. All right. Just a carnival game. And you have to track it. Hey, that'd be a good reason for me to pull up my spreadsheet. Here's my new spreadsheet. Let me hold on. Let me pull up the old spreadsheet so you can see the difference. Now, most of you guys have this. My UTU. Okay, here's the class spreadsheet. Now, this is the one that we look at together here on YouTube. And I'll bring this over here. And this is our YouTube class portfolio. And you can see that we have everything listed here, and we have all these little statistics across here. And this is all pretty nice and fun, and it works great. It works great. But I thought, what if we tried doing a different way? All right. So you can see right here, these are all of our in green, this is all of our dividends that we've been paid. So you can see on YMAG, we've been paid $5,000. On Misty, we've been paid $17,000. On Tesla, we've been paid $8,000. On Microsoft, we've been paid $52. And NVIDIA, we paid $422. And then this is the money that we put in to get that return. So we put in on YMAG, we put in $50,000, and we've got $5,000 back. Misty, we put in $56,000, we've got $17,000 back. Tesla, we put in $54,000, and we got $8,000 back. All right. So we're looking for break even. How long is it going to take us before they give us enough money that we have no more out of pocket, no more out of pocket risk? And that's the whole name of the game, right? We want to get to what we call cash cows. Okay. So, and then we're on the gravy train. So you can see that all listed up in here. And this is the spreadsheet that we're working off of. And this works great. It's a nice little spreadsheet. But I thought, well, what if there's a better way? And I don't know. I'm not saying that this new spreadsheet I got is a better way. I've been using it. And like I said, I'm not necessarily going to say it's a better way. It's just a different way. And what I did is I reorganized it. And so you can see in here, if I bring this over, let me get rid of this one. Don't save. And we're going to bring you over. This is the new one. Now, this is my real money account. So you can see how I've got this. And you can see up in here my estimated total payments. This is a different model in that what I've done is I've come in and I've created little sections for each one. And then I've got the totals coming across the top. So you can see in January, I made $30,000, 29. In February, I made 26. In March, I made 27,000. In April, I made 30,000. In May, I made 34,000. Now, this is just my YieldMax market. That's all. This is all just YieldMax. And you can see each individual one down here. You can come down. So this is Palantir. So you can see where I put money in, and this is how much they paid me. So my money in, and then I got my total infusion. You can see across here where I'm up 15,000, I'm up 9,000, I'm up 800, I'm down 4,000 on NVIDIA. So NVIDIA's got to bring me some more money before I get back to parity. All right. I haven't put any in to help get back to parity, but I'm under 4,000. But you can see that I made 29,000. I put some back in to bring me above. I put some back in to bring me below. So my total so far I've made this year is 160,000. Now you say, well, Lan, what if you go underneath and you're not at parity yet? Well, all it really does is it extends how long before you're back to break, before you're into cash cow. So if I wasn't going to be a cash cow at 9 months, because we had that huge drop for the last 3 months, that took my break even from 9 months to like 14 months. All right. It's going to now take 14 months before I get all my money back and I'm cash cow on my entire account. It pushed my entire account out like 3 months. But so what? It's no big deal. I can bring that back down by taking the money that it gives me and put it back in if I want to. I can take that $30,000 and just put it right back in, which mostly I did in the last 3 months. But if I want to take some out, I take some out too. I've taken about 150,000 out just to cover bills, and I started a new business, so I got money going into that, and just take the money out and spend it. That's what it's for. So you can see how every month that's how much it's given me, about 34,000. Now I can take some of that and put it back in. Some of it I can take out. I've got choices. I can put it back into Palantir. I can put it back into Palantir YieldMax Palantir. I can do all kinds of things. Now that's this model. The other thing that I've got going is I've got loan, I've got cash, I've got seeing these cash withdrawals, and these are not updated yet. So that's why I haven't given it to you. I've not worked in this. Plus, I've got to work in here. I'm right now. The reason I haven't given you this, and it's almost ready to give you if I just wanted the Palantir stuff. But I've also got all my other stuff too. So I bought options. So I got an options table that I'm working on. Shares. I bought a bunch of shares. I'm trying to work shares into it too, because if I just track the problem that I've got is if I've just been like in our old model, when I tracked, where did it go? Oh, I closed it. But I would just track the YieldMax alone. And then if I took money out, there was nowhere I tracked that. And then I was just kind of putting it in a column somewhere. And then if I bought more shares of a different stock, well, I'd take, let's say, $100,000 out of my YieldMax fund and put it over into my just some open shares. Well, that would not show. I mean, it would show that the YieldMax funds were down 100,000 and that cash disappeared into the spreadsheet. There was no reconciliation for it. So now I have $100,000 over in some different stocks, but it shows that I'm losing $100,000 in my YieldMax fund because I didn't account for that. So I have shares, they're valuable, but they're not part of the YieldMax mathematical portfolio. So that was never taken into consideration in the old one, in the one that I gave you guys before. So I'm trying to solve that problem, and that's what I'm in the middle of right now, trying to get if you buy individual stocks, have that represented in your value, because if you don't, otherwise it shows that you lost $100,000, but you didn't really. You put it into a different fund that's not part of the YieldMax world, and so it doesn't get counted for. These are just some problems that I'm trying to solve. See, this is why when my son gets his business going, and this is all going to be taken care of, you won't need the spreadsheet. But right now we need the spreadsheet till he can get that done. And some of you might choose not to subscribe to a service and have it done for you. You'll just want to keep doing it with a spreadsheet, and that's okay. All right, so that's where we're at. Now I want to come in. We're about out of time. I should probably end right here. I wanted to go. I got so much more. You know what? We really do need to go every day. I got so much backed up of things that I wanted to talk to you about. You know what? I got something funny I want to show you too before we go. Give me a second. Give me a second. Look at this. Watch this. Watch this. Hold on. There it is.
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pit News magazine as an example, among others as well. Yeah.
Yeah.
When I heard Elon talking about Pit News magazine, I called in and got a lifetime subscription myself, of course.
Those are not AI, I promise. I promise those are not AI. We would never have a celebrity endorsement made by AI. I thought those were so funny. Look at this.
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pit News magazine as an example, among others as well. Yeah.
When I heard Elon talking about Pit News magazine, I called in and got a lifetime subscription myself, of course.
What do you guys think of that? That was pretty cool, right? Yeah. All right. Pit News magazine. You guys all need to go over to pitnews.com and get your magazine. There's we also have, if you don't have it already, that's how you're going to get the spreadsheet too. Because if you're a subscriber to Pit News magazine, when I come out with this new spreadsheet, that's how you'll get it. I wanted to go through, and then we're out of time. I wanted to go through and show you how our current portfolio is doing, but I got off on my pontification again. Let's open all these charts. These are all of our charts we got positions on, and the thing is, these are options, and most of them are longer term options. Oh look, BMY, bow movement, yes, finally came in. Finally come in. It's going to break. Look, it broke that blue light. Now what kind of pattern do you think that's going to make? It's going to probably come up, and then it's going to flush down, make a little pennant formation right in here, and then it'll go. And we'll look at that and we'll say, is that A1 here? Is that A1 over here? Just like we did with Palantir. I wanted to show you a couple of I have a couple of these little strategies in here. This is called my concave and convex patterns. If you'll notice when you look at patterns, if they're convex or concave like this, they usually have a continuation. If they're convex like this, they usually flush back down. You can see that in there. That's kind of one of my patterns. That's one of my little ways of knowing how patterns are going to work out for you. You kind of watch that and you'll see that happen. Here's another couple of patterns. These are little ABC patterns. And then here's our little wedge and triangle formation patterns. Here's some more longer term candlestick chart formations. And so higher highs and higher lows, lower highs and lower lows. These are your patterns that we're looking for. All right. And so we have a lot of different little patterns, and they're all in this little sheet that I give out. And so these are all in here. Let's see. I ought to give you the link to this. I'll send it out with Pit News magazine with the subscription. I'll give you this whole, look, there's, how many slides are in this thing? There's 186 slides in this little thing that have all these different patterns and all this stuff. If you have subscription to Pit News magazine, this is called the Threes Company pattern. Here's the pyramid scalp and trail strategy. We trade this one. We do this one. We'll probably do some of this one tomorrow on our in our class when we do some day trading. So come by tomorrow and join us tomorrow at 1 o'clock afternoon Mountain Standard Time. Make the adjustments for your time zone, and we'll probably trade this pyramid scalping strategy. But if you have Pit News Magazine, I'll include the link to this. Some of you have it already, but for those of you who don't, it'll be in your Pit News Magazine email. So when email comes out for Pit News Magazine, it'll have it in there. All right, it's got all these different strategies. The ones I wanted to really focus on today was just kind of the little patterns that we talked about. The ABC, the little mountain patterns, the 1 drive, 2 drive, 3 drive. So we're in good shape here. All right, so that's how that works, and that's about all I got for you today, guys.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's what I got for you today. I think we'll call it good right there. And if you guys have any questions, please let me know. Put them down in the comment section. If you enjoyed this little Land Turner pontification on YieldMax funds and why we don't want the yield to go up. Look, you can't see let me move over here. There, now you can see these numbers down here. We're making money. We're up about $26,000. I wanted to go through and liquidate a lot of these, or some of them are long-term. They got like 300 days. So we want to we're getting up to where it's time to put some covered calls on, because we think the market's going to flush right here, right? So this is the pattern we're looking for. We're looking for it to break those blue lights and flush right here. So right now would be a really good time to put on a covered call, because we're going to expect this market to come back down. We can make some money while it's coming back down before it comes back up. Just a short term. We got 304 days here, sell a covered call up here, and wait for the market to come up there. We get a bigger premium, and then wait for the market to flush when it breaks those blue lights, and then we can take our profits off. So we need to go do that. And I'm not going to see you again till Thursday, and these markets are all topping out. Almost, well, that one's not. That's Bristol Myers, but every single one of these are coming in to the blue light crossover. Look at Cisco. That thing's amazing. The blue lights haven't caught up to it yet. Misty, we already broke the blue lights. NVIDIA, blue lights are accelerating. SMCI, and then of course we got there's just so many things we need to do. I just can't do it all in 1 hour. So, but that's the summer school. All right, guys, that's all I got for you. I'm going to let you go. If you have any questions, please let me know. Give me a thumbs up if you thought this was worth your time being here. Hopefully you learned something, and that's it. That's what.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.